is Dr. T. Varalakshmi discussing you about the balance sheet with adjustments and the theory related to this balance sheet preparation under the part of business economics and financial analysis. Balance sheet. It's a final report of the accounting transactions which has taken care by a particular company that shows the assets and liabilities position of the organization. And here the assets should be assets minus liabilities should give the net assets value, whereas the net assets should be equals to the owner's equity of the organization. If we see this balance sheet equation, assets should be equals to the liabilities plus equity of the organization. We'll see with an example. If a person is there and if he has started, if he has 100 rupees of amount, then that he has treated as the capital. With this 100 rupees, he has purchased alus of 3 kilos. 3 kilos of aloo, that is the raw material he has purchased. Here the raw material will be treated as the assets and this 100 rupees will be treated as the equity. 3 kilos worth equivalents to 90 rupees and cash at hand is 10 rupees. This is also treated as 100 rupees. So whereas the 100 rupees equity is now in the form of the raw material worth of 90 rupees and cash form of 10 rupees with the organization. And for this one, he has taken some amount from the friend or a bank or anything from the friend. He has added a liability of from his friend. He has added liabilities worth of 200 rupees he has taken. So now with this 200 rupees, he has appointed a boy by paying 150 rupees for him, that is wages. And oil he has purchased for 100 rupees and he has purchased the gas stove, or for the rent he has taken 50 rupees. So now the total liability, his own capital is 100 and 200 rupees is the liabilities position. And it is in the form of the raw material 90, cash 60, wages 50, oil 100, and that is again the raw material which is 100 and the gas is 50. So which means whatever the transactions which is they are doing, so afterwards if they have done the sales for all this one, again it is called as the profit. That profit will be added to that business organization. So whatever they have invested into the organization, that should be in the form of the either raw material or the assets of the organization. So that's way it shows the final organizational activities in one equation form, whereas the assets should be equals to the liabilities plus equity. That is what you get and what the organization owe and what it has owned for the organization. So owners and his owed amount and entire things which is arranged for the organization. So own, OW and own, what they have gained and what they have owed and what they have invested, that is going to be mentioning. So that's why the cash, inventory, property, everything is purchased because of their investments, because of their loans, etc. So that must be equal under the balance sheet equation. So if we observe this pro forma of this balance sheet, it will considers on the left hand side the debit, that is the liabilities position, and on the right hand side assets of the organization. So this liabilities will include the capital plus the amount which is owed by the organization and the assets which they have gained by the organization, and again it will be terms as the fixed assets and current assets, and the liabilities fixed liabilities and current liabilities. Under the fixed liabilities, land, buildings, plant and machinery, etc. will be adds. Under the current assets, cash at bank, cash in hand, account receivables, bills receivables, inventory, that to the closing stuff of the organization. And under the liabilities position, they have to mention it as the capital, and if any profits are all there, net profits are all there, they will add to that one, and if any net losses are all there, they have to subtract from that one. And the loans which they have taken, current liabilities, bank overdraft, account payables, and outstanding expenses, etc., has to mention under this liabilities position. That is a pro forma. And the title of this balance sheet is balance sheet for the company for the year ended so and so year, mandatorily has to mention. And finally, if the debit balance is equals to the credit balance, then only the accounting transactions are done perfectly without any errors. If there is a differentiation is there, means somehow the mistakes has done in this recording of this previous transactions. That is accounting equation is going to be verifying with the finally preparation of this balance sheet. See, if you see this example of this balance sheet, the first thing indicates the title of the organization, business consultancy company's balance sheet as at 31st December 2015, because they have treated the year as January to the December. So generally the financial year will be from April 1st to the March 31st, and for companies, some companies and foreign companies, developed countries will treat that January to December as their financial year, and some companies, cooperative societies will treat that October to September is the financial year. But most of the Indian companies will follow this budgeting year as the financial year, that is April 1st to the March 31st only. And here assets and liabilities plus stock of the equity. And here the current assets, cash, account receivables, prepaid building rents, unpaid, unexpired insurances, supplies, etc. And the total current assets and the non-current assets like equipment, depreciation. After removing the depreciation only, we have to take the final ones. Depreciation means the reduction in the value of the asset is called as a depreciation. For example, and building is there, that mostly it has the appreciation only, but if it is a machinery is there, but there is a reduction in its value. But for the building appreciation, it is not possible, because that is not selling by that organization, it is not liquidating, but the machinery can be liquidates at any point of time. So that's why depreciation mostly prefers in this accounting transactions. If the machinery 9,000 worth is there, and due to its usage its value is reduced, then that reduction value will be treated as the depreciation. And after the depreciation on that one, they will have to take the real worth of the assets with the organization. But the depreciation will be mentioned under the expenditures for that year under the profit and loss account. Under the liabilities position, the accounts which they have to payable, and the note bills which they have to payable, salaries, income tax, unearned services, and any other equity like capital stock and retained earnings, etc., is going to be categorizing. And all that accounts at assets side should be equals to the accounts at liabilities side. So the features of this balance sheet is, it's only a statement or not at all an account, because it is undoubtedly preparing the entire transactional details of the business organization, and it has no debit and credit sides, but it has the sides of these assets and liabilities. It prepares at a particular period of time, and that too for the end time period it will be prepares, and it's a summary of all the ledgers, journals, trading, trial balances, and profit and loss accounts of the business organization. And it shows the nature and value of the assets and the nature and the value of the investments of the organization for a given date. Its objectivity is to reveal the financial position of the organization and to show the picture of their assets and the liabilities position, and that gives the information to the debtors and the creditors position of the organization, and the liquidity position, that is the current assets and how much of ready cash is there with the organization, and how much of solvency position is there, and what is the fixed assets position of the organization, and everything is going to be depicting with the help of this balance sheet. So that's why this balance sheet is using for the maintaining of the books of records properly, and providing and detection of the frauds, and to know the present value of the final position of the organization, as well as to prepare the further financial statements of the organization, and to compare the profitable results of 1 year to another year or one company to another company. It is acting as a legal evidence and assisting the management to take the better decisions. So that is the advantages of this balance sheet. So there are certain limitations also too, that is recording only the financial aspects, that is quantitative data is only taking into the consideration and the qualitative data is not taking into the consideration. It is historical in nature and provides the insufficient information. That is no cost controlling methods are all not providing, and there is a chance of manipulating of this one, and recording the actual cost into the consideration. The market prices are all not taking into the consideration with this balance sheet. For example, same as with this assets of the organization. Building is purchased for 1 lakh, that is only entering into the balance sheet. If that building price is increased, now the market price of that building is 1 crore, but it is not mentioning under the balance sheet. Only the actual costs are all taking into the consideration. That is the balance sheet limitations. If we see these types of these balance sheets are all preparing based on the format. It is horizontal or vertical, and based horizontal means liabilities as well as assets. They prepare like this, that is called as horizontal. So liabilities, afterwards assets, they will prepare, then it will be called as horizontal. And based on the usage, consolidated or standalone. Only within the organizational assets and liabilities they prepare, that is called as the standalone balance sheet. For the entire organizational levels, if they take into the consideration for the entire groups, they will prepare this balance sheet, then that is called as the consolidated balance sheet. And for this year, it will based on the time period, current year balance sheet and previous year's balance sheets. So the balance sheets with adjustments means in any accounting transactions, while entering into this journals, ledgers, everything, if any mistakes has done, or if any recordings were not realized by the time of that one, then that will be preparing or treating as the adjustments. In that accounting period, by the end of this March 31st, the organization was unable to receive some any outstanding expenses. Later on, they have received. Then they have to add under the adjustments. That is, an accounting adjustments of the business transactions is not yet done or anything has not considered. That will be treated as the balance sheet adjustments. So most of the transactions are all eventually recording through this invoices, customer bills, or the receipts of the cashier only. If any unrealized transactions are all there, that unrealized transactions were done after the time period, then they have to treat as the adjustments. Some of the examples of these accounting adjustments is altering the amount in a reserve account, such as the allowance for this doubtful accounts or the inventory obsolescence reserves. So future expectations, if they want to maintain the reserves, out of their profits only they will prepare. So after preparing the balance sheet only they will prepare this one. So that allowances they can treat as the adjustments. And any recognized revenue that has not yet been billed. For example, the outstanding stock is that they have received the orders but not yet paid by the person. If that amount is received after the preparation of the balance sheet, that will be treated as adjustments. And deferring of the recognition of the revenue that has been billed has not yet been earned means, though it has billed, but if it has not paid, later it is paid. And when, for example, check is received by the organization, that check is not realized. Under the realization concept, once it has done, then only it has to treat under the accounting. So what happens is, so that check is deposited in the bank after 2 days of this end of the financial year, then that unrealized expenses will be treated as this expenses. So like this, any unrealized accruals etc. will be treated as the adjustments under this accounting adjustments. all these adjustments will be adjusted with this balance sheet, and if they re-modifies that previous one, then it is called as adjusted balance sheet. So that is about the balance sheet, its examples with some adjustments. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.